In this video, I will discuss my top 5 ETFs offering high dividend yields. Let me tell you what I'm not going to do. I'm not going to slap at you a bunch of names, a bunch of charts, and show you a bunch of metrics. What I will do is this. I will discuss costs and benefits of each of these ETFs, and I will also talk about under what circumstances these ETFs will perform well or fail. When I was choosing these 5 ETFs, I used the following criteria. First, I made sure that each fund has at least several billion of dollars in assets. This ensured that the fund will stick around. Second, I avoided funds with excessive expense ratios in the realm of 1% or higher. Very seldom high fees make sense. And finally, I chose funds from different asset classes. These include preferred shares, equity, or derivative income. I excluded bond ETFs from this discussion. The first ETF on the list is the heavy hitter JPMorgan Equity Premium Income ETF, or JEPI. With 31 billion in assets, expense ratio of 0.35%, JEPI offers a dividend yield of 8.4%. This fund selects stocks based on JPMorgan proprietary ratings with a focus on downside protection. The fund holds 130 plus securities and it is well diversified at the top as we see here. But the fund employs the so-called covered calls strategy. This strategy allows the fund to earn time premiums on call options that the fund sells short on its portfolio, without getting too technical here. Sounds great, right? Well, there is a catch here. While this call options premiums produce extra income to the fund and produces its high dividend yield, it caps the fund's upside. This means that the fund will underperform exactly the same portfolio without covered call strategy in a trending bull market. Conversely, covered call strategy flourishes in volatile markets. This is because the value of a stock option tends to rise when there is a volatility in the prices. So this means that the JEPI will shine in a volatile sideways or bear markets. As for the performance, let's compare it to the gold standard of dividend ETFs, which is SCHD. Unfortunately, JEPI got started in May 2020, so there's not much to compare. But we see that JEPI outperformed SCHD on a one-year basis. This is likely so because many big tech companies included in JEPI but excluded in SCHD outperformed high-yield value stocks. A more fair comparison is to S&P 500. Here we see that S&P 500 massively outperformed JEPI. If we look at S&P 500 chart, it becomes clear why. The S&P 500 was in a major uptrend. Because JEPI uses covered call option strategy, its returns were handicapped. So that's a lesson learned. As for the 3-year performance, JEPI matched SCHD and slightly underperformed S&P 500. During the last 3 years, the market got pretty much nowhere. This allowed JEPI to perform well. But even so, plain vanilla S&P 500 ETF would have fared surprisingly better. Another issue with these so-called covered calls strategy funds like JEPI is taxation. Due to its structure, the distributions from JEPI and similar funds are treated as an ordinary income, and ordinary income is taxed at a higher tax rate compared to, say, qualified dividends. So it becomes even more important to hold JEPI in a tax-deferred account, otherwise you'll be paying a whole lot more taxes. I made a video where I explain in detail what dividend taxation is, linked here. Similar funds to JEPI are QYLD and RYLD. They offer even higher yields by doing more of the same thing and tracking other indices. So keep these things in mind the next time you see a covered calls ETF and its enticingly high yield. The next ETF is iShares Preferred and Income Securities ETF. This ETF invests in preferred shares of large US financial companies. These include JPMorgan, Wells Fargo, and Citi. The fund has 14 billion in assets with a somewhat high expense ratio of 0.46%. The annual dividend yield stands at 6.65%. Overall, the fund has over 450 holdings and is well diversified. But here's what to know know about this fund? PFF invests in preferred shares, which exposes investors to unique risks. First, preferred shares are more like that than a common equity. They pay fixed dividends and get priority over common equity in case of bankruptcy. Preferred shares are even rated by credit rating agencies in the same way as bonds. So they're subject to credit risk exposure. For instance, take PFF. Its portfolio is mostly rated as BBB, which is investment grade, but it also has exposure to non-investment grade securities. Because preferred shares are like that, they are also subject to interest rate risk. So think of preferred shares as a long-dated bond that is very sensitive to interest rate changes. As we see here, when the Fed signaled interest rate hikes in 2022, PFF plunged. As for the total returns, PFF underperformed both SCHD and S&P 500 for the past 10 years. Even though SCHD has a somewhat lower yield, its price appreciation made it a much better choice. The third high-yield ETF is Vanguard International High Dividend Yield ETF, or VYMI. The fund has $7 billion in assets with expense ratio of 0.22%. The fund provides exposure to developed markets. Its focus is on high-yielding stocks outside of the US. The dividend yield is 4.6%. The top 5 countries are Japan, UK, Australia, Canada, and Switzerland. The fund is well diversified across many sectors with a slight tilt towards financials. The number of holdings is way over 1,000 companies, with top 10 holdings accounting for a mere 14%. But here's what to know about this fund. It is subject to foreign currency fluctuations and risk. If for any reason a foreign currency depreciates against US dollar, the performance of this fund will suffer. Take for instance a recent episode where Japanese yen depreciated by a whole lot. This was terrible for VYMI performance. The second thing with VYMI is that it selects its stocks based on yields, and higher dividend yield stocks tend to expose this fund to value traps. Also, the higher dividend yields stocks may show smaller price appreciation. So those are the risks that you should be aware of. Again, comparing VYMI to SCHD and S&P 500, we see a large underperformance across different time periods. The fourth fund is Vanguard Real Estate ETF, or VNQ, giving you exposure to over 160 US REITs. The fund has $32 billion in assets, a low expense ratio of 0.12%, and a dividend yield of 3.96%. The fund's top 10 holdings account for 48% of its assets. As with any REIT, VNQ is sensitive to interest rates. The Fed's rate hikes caused underperformance of this fund for the past several years. So almost always the rising interest environment is bad for the performance of this fund. Looking at the fund's holdings, we see that it doesn't concentrate on any particular type of REIT. Apartments, shopping malls, business and cell tower REITs have a good representation. This may shield VNQ from declines in any particular segment of the real estate market. On the other hand, most of the VNQ's distributions are taxed as ordinary income, so this is another thing to keep in mind, especially if you're going to hold VNQ in your taxable account. As for the performance, VNQ's returns were inferior to both S&P 500 and SCHD, especially on a 1, 3, 5-year basis. The main reasons are rising interest rates and problems with commercial real estate. On a 15-year basis, VNQ showed a much better returns because rents in the US rose significantly over the past 15 years. VNQ benefited from strong demand for data centers, logistics, cell towers and residential properties. But any negative outlook for rents can cause severe underperformance for this fund. And the final, fifth high-yield ETF is Schwab Fundamental Emerging Markets ETF, or FNDE. This fund has $5.3 billion in assets with expense ratio of 0.39% and a yield of 4.73%. The fund focuses on emerging markets. Here's the breakdown of its holdings by country. We see that China, Taiwan, India and Brazil take the lead. FNDE used to have large holdings in Russia, but they got removed after the invasion of Ukraine in 2022. The fund is not top-heavy, with top 10 holdings accounting for 24%. The first thing to notice is the fund's exposure to basic materials and energy. Because commodity prices tend to fluctuate, this introduces volatility into FNDE's performance. Second, investing in emerging markets comes with its own host of issues. For instance, the developing markets, they tend to have weaker rule of law and less stable economic policies. So this creates unique political risks. And for this reason, government meddling in private sector is common and widespread. China is most notable for this. The ousting of Jack Ma and curtailing gaming activity had severe negative effects on Tencent and Alibaba. Also, foreign currency risk is even bigger in developing countries. Turkish lira and Brazilian real are cases in point. Their massive depreciation against the US dollar made FNDE performance very poor. Comparing FNDE performance to S&P 500 and SCHD, we see that the fund got almost nowhere for the past 10 years. Not a good sign. So, what kind of conclusions can we draw from all this? The first thing to notice is that higher dividend yields almost always come with a lower price appreciation. Take, for example, SCHD. It has a lower dividend yield, and still it outperformed almost all of these funds that I just talked about because of the price appreciation. All these funds came with their own unique trade-offs. This made them either stellar or terrible performers depending on the market condition. Remember those cover call strategies, ETFs with astronomical yields? They will underperform in a trending bull market and outperform in volatile, sideways or bear markets. Of course, there are outright bad choices. By that I mean emerging markets. It's typically a bad idea to chase a slightly higher dividend yield at the expense of exposing yourself to greater amount of risks. As a US investor, I would rather look for something at home. Finally, it's almost always a good idea to hold high dividend yield ETFs in a tax-deferred account. Otherwise, the recurring dividend income will be triggering taxes every year in your taxable account. And depending on an ETF and your taxable income, your tax bill can be substantial. On another note, if you are young and have many working years ahead of you, I would look into growth ETFs, especially the ones that track Nasdaq 100. I made a video where I explained reasons why this is so. That is it for this video. I hope you learned something new today and you got something out of it. If you did, please give this video a like and subscribe to my channel for more content about personal finance and investing. Thank you for watching.